$15 trillion didn't drift out of the market, it was ripped out. Gold didn't pull back, it broke. Silver didn't correct, it collapsed. And while you're watching this, the numbers are still moving lower. This is not hindsight analysis. This is happening in real time, screens refreshing every few minutes, prices stepping down, liquidity vanishing between ticks. What you're watching is not a change in sentiment. It's a mechanical failure. Markets don't move like this because people suddenly change their minds. They move like this when leverage collides with margin requirements and there isn't enough cash left in the system to absorb the shock. That's the anatomy of this crash. Most traders don't trade metal. They trade exposure. They post a fraction of the value and control the rest with borrowed balance sheet. That works until the rules change. And the rules did change. Margin requirements didn't rise once. They rose repeatedly, relentlessly. Each increase demanded fresh capital immediately. Not tomorrow, not after funds clear, now. If the cash wasn't there, positions were closed automatically. No discretion, no negotiation. That kind of selling has nothing to do with price discovery. It's liquidation. When thousands of accounts are liquidated at the same moment, price doesn't fall smoothly. It gaps, it air pockets, it overshoots. That's why support levels didn't matter. That's why models failed. That's why the move feels violent and irrational, because it is. But here's where people make the biggest mistake. They assume the price on the screen reflects reality. It doesn't. That number is the clearing price of a leveraged paper market under stress, nothing more. At the exact same moment, silver futures were collapsing in New York. Physical silver was trading dramatically higher elsewhere. Same metal, same day. That gap isn't an anomaly, it's a signal. If silver were truly worth what the screen says, buyers wouldn't be paying far more in physical markets. Manufacturers wouldn't accept it, institutions wouldn't tolerate it. They would arbitrage it instantly, unless they can't get the metal. This is where the story stops being emotional and starts being structural. Paper markets are built on rehypothecation, multiple claims on the same ounce. That system functions only as long as most participants settle in cash. The moment physical delivery becomes important, the math breaks. And delivery has become important. Physical metal has been leaving vaults at a pace that doesn't align with a crash, not traded, removed. That requires trucks, security, warehousing. Retail can't do that. Institutions can. At the same time, lease rates have surged to levels that scream scarcity. You don't pay extreme rates to borrow something that's abundant. You do it when availability is tight and timelines matter. This is the divergence most people never see. Paper screaming collapse. Physical holding firm. That divergence doesn't last forever. One side is lying. And it's usually the side that can print claims infinitely. This is why the timing matters so much. When margin rules tighten aggressively ahead of major delivery windows, it isn't random. It reduces open interest. It forces cash settlement. It removes pressure from the physical system. That's not conspiracy. It's risk management by exchanges that understand counterparty exposure better than anyone else. Now zoom out. Nothing about the underlying fundamentals improved overnight. Supply didn't surge. Demand didn't vanish. Industrial consumption remains real. Strategic stockpiling hasn't reversed. Mining output didn't suddenly spike. What changed was positioning. Excess leverage was flushed. Weak hands were removed. Balance sheets were forced flat. That kind of reset is brutal, but it's also clarifying. After events like this, markets don't immediately become calm. They become thin. Volatility stays elevated. Moves become erratic. Confidence evaporates. But the selling pressure changes character. The forced sellers are gone. The remaining participants either can't sell or won't. That's when paper prices stop behaving the way people expect. This doesn't mean price immediately rallies. It means downside requires new sellers, not just fear. And new sellers are harder to find when exposure has already been destroyed. This is where survival matters more than conviction. Many traders were right about the metal. They were wrong about their structure. They didn't lose because silver collapsed. They lost because they couldn't meet margin. That distinction is everything. Markets don't reward being correct. They reward staying solvent. Right now, the only things that matter are not opinions or targets. They're signals. Is the gap between paper and physical widening or closing? Are vaults still draining? Are lease rates staying elevated? Those answers tell you whether this is resolving or escalating. Because if this were a true demand-driven collapse, physical would be falling faster than paper. It isn't. That tells you this move is about stress, not value. And stress always exposes who actually controls the asset and who just rented exposure to it. Paper can fall far below reality when forced to. Physical cannot. At some point, those two worlds reconcile. They always do. The only uncertainty is how much damage happens before they meet, and whether you're positioned to survive long enough to see it. What comes after a move like this is not relief, it's confusion. Price stops collapsing, but it doesn't stabilize either. Every bounce feels fake, every dip feels dangerous. That's not weakness. That's a market that just shed too much leverage too quickly. After forced liquidation, markets don't immediately reward optimism. They test patience. Volume thins out, Liquidity becomes selective. Moves happen faster in both directions because there are fewer participants left to absorb them. This is where most people get chopped up. They try to trade certainty that doesn't exist yet. They look for clean confirmation. They wait for headlines to tell them it's safe again. Markets don't work that way. The real signals are quieter. If physical buyers were spooked, premiums would collapse. They haven't. If institutions were suddenly flush with metal, lease rates would normalize. They haven't. If delivery pressure were easing, vault withdrawals would slow. They haven't. Those facts matter more than the candle on your screen. This is the part where paper prices can continue drifting lower, even while the real market underneath tightens. That disconnect feels irrational, but it's not. Paper markets clear fear. Physical markets clear necessity. Manufacturers don't care about narratives. They care about inputs. They don't wait for confirmation from CNBC. They secure supply. That's why physical markets often lead turns without announcing them. This is also why experienced operators don't chase bottoms in environments like this. They wait for exhaustion. Not emotional exhaustion, structural exhaustion. You see it when selling fails to accelerate on bad news. You see it when price dips stop triggering cascades. You see it when volatility compresses without leverage rebuilding. Those conditions take time. Anyone telling you they know exactly where the bottom is doesn't understand how these markets work. Support levels are meaningless when selling is forced. They only matter again once selling becomes discretionary. That transition is subtle, and most people miss it because they're still focused on price instead of behavior. Another hard truth is that crashes don't end because fundamentals assert themselves. They end because sellers run out. Right now, most of the selling you've seen was not choice. It was obligation. Margin doesn't negotiate, it liquidates. Once those accounts are gone, the market is left with participants who can actually hold risk. That doesn't make them bullish. It makes them stable. Stability is what markets need to rebuild. This is also where asymmetry quietly shifts. Before the crash, upside was capped by crowded positioning. Everyone who wanted in was already in. After the crash, downside becomes capped by the absence of forced sellers. That doesn't mean price rockets higher. It means declines require new reasons, and new reasons are harder to manufacture than margin calls. This is why volatility often collapses right before significant moves, not because the market is calm, but because pressure is being redistributed. The biggest mistake people make now is assuming time heals everything. It doesn't. Structure does. If paper prices continue falling while physical refuses to follow, pressure builds invisibly. If that gap widens, confidence in the screen price erodes. When confidence erodes, participants adjust behavior. Cash settlement becomes less attractive, delivery becomes more important. Counterparty risk moves from theory to concern. That's when paper markets lose control of the narrative. But this process is not clean. It's messy, and it punishes impatience. Many traders who survived the crash will still lose money afterward, not because they were wrong, but because they tried to force clarity before it existed. The market doesn't owe anyone resolution on their timeline. Right now, the only advantage is awareness, understanding that this was not a vote against metal. It was a vote against leverage, understanding that price is not value when claims exceed reality. Understanding that paper can deviate far longer than seems reasonable, but not indefinitely. History is very consistent on this. Whenever paper and physical diverge meaningfully, one side eventually yields. It is never the side constrained by physics. Metal doesn't care about margin. It doesn't care about narratives. It doesn't care about positioning reports. It exists or it doesn't, and that's the anchor beneath all of this noise. Crashes like this don't mark the end of cycles. They mark transitions, from expansion to contraction, from complacency to caution, from leverage to liquidity. The damage is real. The losses are real, but so is the information. Markets reveal their true structure only under stress. You're seeing that structure now. Who controls price, who controls supply, who survives volatility, and who doesn't. That clarity is expensive, but it's also valuable. Most people will remember this moment only as pain. A few will remember it as insight, and the difference between those two groups is not intelligence, it's preparation, knowing what you own, knowing how it trades, knowing how it breaks, because the next move doesn't belong to the loudest voices, it belongs to the participants who are still standing when the dust finally settles.